What's going on, everybody? This is my first time on StreamYard, so forgive me. I'm usually on Zoom, and we just had this countdown, which is really cool to let you guys know that we're going to be streaming live. I believe we're live on YouTube as well, so super excited to have everybody there. I'm out of my studio. Been traveling all around South America, and so I don't have my nice background. I don't have my my usual spot, but yeah, we're looking forward to some good stuff tonight. We have Lorenzo Abbatiello on, that's going to be coming on after I present, because we're going to wrap in a strategy for you all so that everybody can see exactly what we're doing to minimize our tax liability when it comes to crypto legally. All right. So, you know, a lot of people, I have a lot of students who come and they end up telling me, you know, hey, look, how can I, you know, not pay taxes on my crypto? And my answer is always the same, because I've been paying taxes on my crypto since I got into crypto. And the thing that I always say when it comes to taxes is, look, I get that you want to minimize your taxes. I get that we all don't want to pay taxes, and especially right now with the current situation of how our government spends money. And when I say our government, it's mostly all governments. They usually are spending more than they're actually taking in. And so Lorenzo and I have been working together for quite some time now, and about almost 2 years. And when he and I first met, I was like, dude, you've got some amazing strategies that can really help people do well. And the fact that he understood DeFi, which is what we're going to be talking about tonight, and how it all weaves in, I was like, this is our guy. I mean, there's nobody who understands this stuff better. And he's become an integral part of my company, ARC. And he's also been featured on all sorts of other places, other huge influencers, and he's worked on other huge influencers' accounts. So without further ado, I'm going to start with my part of the presentation, because again, it weaves into his and how the strategy works. So let me go ahead and pull up my screen here. All right. So we're calling this the ultimate strategy to minimize your crypto tax liability. Now, as always, guys, gals, this is not financial advice. All right. And Lorenzo is giving you strategies in order for you to fully understand your particular situation. You must consult with a professional, especially when it comes to the tax side. You know, and on the crypto side, I would say, because not very many financial advisors understand crypto. I've met with lots of them. I used to be one. And so I would, instead of maybe going and talking to your financial advisor about crypto, I would be investigating about crypto myself. I would be learning about crypto myself. Now, when it comes to securities and all sorts of different things, I think that's where you would probably go and talk to a licensed financial advisor, because those are the products that they deal with, okay? Insurance, all these things. But when it comes to crypto, I always encourage people, do your own research. Don't take my word for it. Don't take Lorenzo's word for it. Don't take any crypto influencer's word for anything. Go research, and if it resonates with you, then jump in, you know, and forever keep learning, because this is how we can really do well in crypto. It's how I've done well. So let's talk a little bit about what DeFi is, okay? So DeFi stands for decentralized finance. And essentially, you do what the banks do to make money, except there's no third-party intermediary, okay? And so here's an illustration of how DeFi works. Or I'm sorry, the difference between CeFi, or centralized finance, and DeFi, decentralized finance. So Sarah here deposits her money into the bank, all right? Then the bank takes that money and invests it in institutions, and the institutions usually will take it to brokers. Then brokers will, take it to retail, which would be, Robert, or even back to Sarah, all right, in the form of an investment. So, a stock, a bond, a credit card, a mortgage payment. All right. All of these things brokers handle, and there's different types of brokers for different types of products. Okay. But this is essentially how the banks and institutions, so this is the institution, this is the bank, and then this is the broker. All along, all of these people in this middle here are making money off you and off you. Okay. Sarah and Robert. Okay. And the cold part is this. And when I really learned this, I felt a little bit like a clown because I didn't understand, but they designed the system like that. So don't feel bad if you didn't understand this from the get-go. But I'm essentially investing my money into the banks so that they can basically loan it back to me and charge me for my hard-earned money. Kind of a shitty thing, right? When I found that out, though, I was like, there's got to be something better. Well, there is. So you have something called decentralized finance. So decentralized finance, Sarah's able to deposit her money into the blockchain, okay, into borrowing and lending protocols or liquidity pools, which we're going to talk about here in a little bit. And she's able to allow Robert to trade peer-to-peer, borrow money against his crypto or against his virtual assets. And guess who makes the money? Sarah. So Sarah deposits her money, or even if Robert deposits his money, he can make money directly off Sarah. And there is none of these third parties that are there to take a cut from anything. All right. And in my opinion, this is a way that we're going to solve our financial crisis, our current financial crisis. This debt Ponzi scheme designed really by the Rothschilds to keep us all enslaved. All right. And make no mistake about this. The current financial system is a form of slavery. Because why is it that these guys are all using my money in order to enrich themselves? It's my energy that I've put out, and now they're enriching themselves. It's not right, and it's changing. Now, let's talk a little bit about what centralized exchanges are, because this is a big thing that we're going to be talking about tonight. So centralized exchange is something like Coinbase, the New York Stock Exchange, the NASDAQ, Binance, okay? Centralized exchanges basically take custody of your money and crypto and stocks in the cases of New York Stock Exchange and NASDAQ, all right? These guys all have custody of your energy, of your money, of your crypto, okay? And when we give that away, we become very, very vulnerable because guess what? These guys are using your stock or your crypto to make money off of you, okay? And this is something else that I learned back in 2020 that made me millions of dollars. All right, and I'm going to show you how here in a little bit. So what is a decentralized exchange? Well, a decentralized exchange is a peer-to-peer marketplace. What does that mean? We don't need to keep custody in an exchange in order for us to feel safe, or they use our money to make money off of us. All right, and so you're going to hear this word a lot when you get into crypto, non-custodial, okay? Non-custodial. Non-custodial means I'm actually holding the crypto. Nobody holds that crypto except for me, all right? And without the need for an intermediary to facilitate the transfer and custody of funds. So this means I have all this stuff in my control. Now, compared to traditional financial transactions, which are opaque and run through intermediaries who offer extremely limited insights into their action, decentralized exchanges offer complete transparency into the movement of funds and the mechanisms facilitating exchange. All right. And so this is something that's really interesting, though, because limited insight. So right now, let's say, for instance, our in the United States, the senators, the congressmen and women, when they make a trade, they only have to disclose those trades like anywhere between 45 and 60 days after they've already made the trades. It is not transparent. When Warren Buffett makes a move, he does the same thing. 45 to 60 days later, he's showing people what he invested in. On the blockchain, it's fully transparent. So once everything goes to the blockchain, you'll be able to see what Elizabeth Warren or Nancy Pelosi or Ted Cruz is investing in. Okay? And this is a big deal because, look, there's no doubt in my mind that all of those people that I just mentioned are performing insider trading. And there's all sorts of laws that protect them, which is really shitty. All right? But I'm cool. All right, fine. You want to insider trade? Let me see your transactions in real time. And they don't like that. They don't like that. Okay? Because now it gives access to all of us. Where in crypto, I follow some wallets that I respect and I see, oh, wow, these guys really know what they're talking about. I can see every single move they're making in real time. Now, what is a liquidity pool? We're going to break this down for you here in the next few slides. So a liquidity pool is a crowdsourced pool of cryptocurrencies or tokens locked into something called a smart contract. So think of a smart contract as like a pre-programmed contract that is designated to do exactly what it says. All right. So like if I put my money in here and somebody uses my money to trade, I'm going to make 1% off every single trade come heaven or high water. Okay. Now it's used to facilitate trades between the assets on decentralized exchanges. Instead of traditional markets of buyers and sellers, many DeFi platforms use what are called automated market makers, or AMMs, which allow digital assets to be traded in automatic and permissionless manner through the use of liquidity pools. So like another thing that I'm not a fan of is the government telling me what I can and cannot buy. Like, we're not 5, guys and gals. And while I'll tell you, I've been scammed before. I've bought what we call a shit coin before. It doesn't feel good. But at the end of the day, I'd rather actually learn that lesson on my own than have some government big brother sitting there telling me exactly what I can and cannot buy. Because if I find an opportunity that I really, really like, well, that's on me if I lose my money. And decentralized exchanges allow us to do that. They allow us to buy these cryptos in a decentralized fashion so that we can be exposed to really good opportunities. Okay? So here's an example of what a liquidity pool is. So in a liquidity pool, you get paid in the 2 cryptos that you put into the pool. So you always have to have 2 cryptos. All right. So one XYZ crypto and the other is this. I think this is Bancor token. All right. So in this case, XYZ token and BNT token. When you create a liquidity pool, you get liquidity pool tokens, which represent your percentage of ownership in the liquidity pool. So for example, if I put in $10,000 into a pool with $100,000 total, I own 10% of that pool. So let's say, for instance, if I end up earning whatever, 1,000, or the whole pool ends up earning $1,000. Sorry, my writing isn't so good. In one day, well, I get $100 out of those fees. And those fees are divvied up using smart contracts. All right, it's not there. These are fully public things. They're not like MLM or some secret thing. This is available to everybody in the world, guys and gals. So here's another example to help you understand this a little bit better. So let's say, for instance, we've got Apple stock, all right? Well, in order for me to buy Apple stock, I need to go to the NASDAQ. And the NASDAQ provides liquidity, all right? So every single time there's a trade between my dollars and Apple and my dollars, okay, a trading fee is assessed. And those fees on average in the NASDAQ are anywhere between $10 and $150. Now, here's the cold part. The NASDAQ keeps all of the fees generated, okay? Nobody ever called you up and said, yo, Bob, Cindy, listen, we want to get you in to these liquidity pools in the NASDAQ. So, and I see you have some Apple stock. You mind putting that up so people can trade peer-to-peer and you're going to make a cut off every single trade? Said no centralized exchange ever. All right? But make no mistake, these guys, the NASDAQ, the New York Stock Exchange, they are making billions of dollars off of allowing you to come to their exchange and make those trades. So here's an example of a cryptocurrency liquidity pool that I put together many months ago, actually over a year ago, okay? And I've done various different ones, but this is just a screenshot that I have. But so instead of Apple, think of FXS as Apple and Ethereum as dollars. And every single time a trade is made between FXS and Ethereum and FXS, a 1% fee is assessed. And with that 1% fee, okay, based off of how much I was going to put in, I was going to be earning $14.33 per day, or annualized out 523% per year, okay, based off of the volume that was coming in and out. Now, these rates, they fluctuate. What do they fluctuate on? Well, if not very many people bought FXS or ETH or sold their FXS on that day, well, then that liquidity pool APR is probably going to go down, right? Now, if double the amount of people come and buy, well, this amount could be double. But it is a variable amount, so it's not fixed. Anytime something is fixed, like, yo, we're going to guarantee you 5% per month or 10% per month. The only guarantee that I can tell you with things that are guaranteed, especially in crypto and in traditional finance, is that you're guaranteed probably getting into a Ponzi scheme and you're going to lose your money. All right. So, but this is a legitimate cash flowing way of making money. Here's another example, USDC and ETH. So USDC is what's called a stable coin. And these stable coins are backed 1-to-1 by the United States dollar. So it's just like Bitcoin, right? You have Bitcoin. Bitcoin fluctuates in dollar value. USDC is always ever going to be worth $1. All right. Now, Ethereum, on the other hand, is variable. It's going to go up and down against the dollar, right? Well, in this situation, because there's more volume, okay, I'm making 0.05%, so the traders actually pay less fees. But because there's more volume, look at what the percentage rate is here, 1,217%. Now, again, the rates fluctuate, and they're definitely not there right now, okay? They're definitely not there right now, but they're starting to pick up again. And I think within the next few months, we'll probably start to see rates get back up in here to the 1,200%. Now, I want you guys to read this here. Results not guaranteed, and results vary on market conditions. So don't come here and be like, oh my gosh, this guy showed me this thing and people are making 1,000% per year just scratching their butts. No, that's not what I'm saying. You do have to learn how to use this technology because there is risk here. All right, there is risk, which we're not going to talk about tonight. But And by the way, I've made this money. So when I give you these estimates, I have actually made this money, okay, and more. So this means like if I were to put money into this FXS ETH pool, the first pool that I showed you, in 1 year, $10,000 should be worth $53,200. And that's if it just stays flat. That's if Ethereum and FXS don't go up, which they have substantially this year alone. Same thing here. If this $10,000 is invested in this ETH USD pool, this is if ETH, because USD is always going to be flat. If ETH stays flat, well, then I would have made $127,000 from $10,000. And again, I've seen this over and over and over again. All right. Now here you can see this is something called our managed vault, and this is ties into our tax strategy. Okay, so the managed vault, okay, allows you to earn fees, but us managing it for you in a decentralized way. We don't take any possession of your crypto, but we'll talk about that here in a second. But right here, you can see my unclaimed fees. So all we have to do is come here, collect fees, and boom, this goes directly into our wallet in the blockchain, not in some shady centralized exchange, in a public decentralized ledger, okay, where only I have control of this money. Okay, same thing here. This is IMX and Ethereum. These are some fees that we had already earned. If I hit this collect fees button, boom, this gets zapped into my wallet. All right. So it's very, very simple, guys and gals. This is not rocket science, but you do have to learn the skills. You do have to learn the skills. Here's just some other APRs. And you can see, again, this one's FXS ETH. This one was taken a little bit later down the line. It went from 500 some percent to 230%. Now, the next day, it could jump up to 700%, depending on how much volume. Here's another one. Curve Ethereum, 155%. Convex Ethereum, 177%. And guys, gals, this isn't in the increase of my crypto. If my cryptos go up, that's even more money in my pocket. Now, they can also go down. But I can tell you that while this bear market, which, by the way, for those of you who don't know crypto, we've been in a bear market over the last year and a half. I believe we're actually starting to get out of it now. But the bear market, even though my cryptos were going down, a lot of them, I broke even though they were down 50, 60, 70%. Why? Because I was earning more of them in fees in order to offset those losses by allowing people to trade peer-to-peer. Now, here's some actual profits that I took, all right? And I want to show you guys this because this is important. So right here, and this was all inside of 30 to 45 days. Each position I cashed out in different times. But this one I invested $13,136. And I ended up earning within 30 days or 45 days, I can't remember exactly what the time range was, $16,947 in profit on top of this $13,000. So the total was $29,538. Right here, here's another one. I put in $10,000 in this one. Look at this. $30,000 pretty much in profit. This one didn't do quite as hot, but still did really, really, really well. This one I started with, I believe I started with about $5,000. Look what it turned into. $62,000 plus profit of $36,000. This one here, $4,000 plus profit of $6,800. Big difference. So here's how we're printing money, all right? So what is the managed vault, all right? And again, pay attention because we're going to get into the tax strategy real soon. So the managed vault is a decentralized pool of money where coaches of the ARC, my company, AI and bots, will be managing the investment strategies that the funds will follow. So these vaults will be using what's a decentralized exchange called Uniswap v3 as the primary strategy to make profits for its vault members. The vault is fully transparent, and I'll show you that here in a little bit, and you will be able to see every bit of movement within the vault at all times. Now, the only one who can withdraw your money from the vault is you. Okay, the ARC will not be able to remove any of your investment because it is predetermined with smart contracts that are fully audited by third parties, assuring you that these contracts do exactly what they're meant to, what they say they do. So you see, we want to have control of your crypto portfolio, but not take custody of your money and hide what we do with it, which is, so many hedge funds, and I'm not saying that they're all bad, but wouldn't you rather have full transparency in an easy to read manner so that you're like, oh, okay, there's my money. These are the strategies these guys are using, and I can see it in real time right there. Instead, you get this like statement at the end of every quarter or month or whatever. You really don't get access to the centralized exchanges, but you're in a fund, okay, and there's a lot of regulation around that, okay, but here it's fully decentralized, meaning you have custody of your money, and it's fully transparent, meaning you can see every single thing that is going on. So how do we truly build wealth in crypto? We want to learn DeFi, because you do have to learn DeFi, all right? I don't want to, this isn't like an investment where it's just like, oh, let me just put my money with him because, whatever, he's got a nice smile or I like what he had to say. No. We want you guys and gals to learn DeFi, okay? So you want to learn DeFi, but have the pros manage your crypto without ever losing custody of your crypto. So you can see here, all right? It's fully decentralized. And I'm gonna actually open it up here in a second, all right? It's fully transparent. These are all transactions, all right, that have transpired. And you can go back all the way to the beginning and see every single transaction if you wanted to. It's fully managed. So we have these liquidity pools, which you do need to manage liquidity pools, okay? Fully managed. And only students of the ARC can join the managed vault at this moment in time. Now, here's the way it works. We do have a fee structure, all right? So there is this is actually 2.5% management fee that's paid over each year. Sorry, 2.5%. So I forgot because we actually changed this here. We have a 17.5% performance fee. So if you don't make any money, okay, you're not going to end up paying this chunk of money here, all right? If you're break even or if it goes down, you will never, ever, ever pay this money, okay? And then there is an exit fee of 1.5%. Now, there's a minimum of 2,500 due to the Ethereum gas prices because these smart contracts, they're very complex, all right? And because this is a very new strategy, guys and gals. So in order for it to be worth your while, we set this at 2,500. We could have set it at 100 or 50 bucks, all right? But the problem is in gas fees, which is how people make money in Ethereum, like what gives Ethereum utility, you have to pay gas fees, okay, for every transaction that goes through. Well, if you were to get into this, usually the transactions can run $100 or $150. So would it be worth your while to put $50 in, but pay a gas fee of $150? And this is why we've got this minimum here. So the requirements to get into the managed vault are as follows. So there's a minimum of $2,500. You must sign and understand a disclosure. You must show that you understand what you're investing in. A test will be provided. And it's very simple, all right? But listen, guys, gals, so many people nowadays blindly get into investments, all right? The managed vault in the last 90 days is up over 55%. That sort of stuff gets people crazy and riled up. They'll throw money in like blindly. I don't want that from any of our people, from any of our investors. What I want is I want educated investors so that they, one, understand the strategy, two, understand what they're investing in, three, understand the cryptos that are in this, because there's like 12 or 15 different cryptos that we're invested in. Okay. And we want to make sure that you guys and gals really understand what you're getting into. So that way, if somebody ever asks you, you're like, oh yeah, it's this and this and this and this. It's really simple. And it's not going to take more than probably 2 hours of your time. All right. To like go through all this and deposit and take the test. It's very simple. But we just want to make sure that you're not like jumping in, you know, without even thinking about it. Now, how is this taxed? All right, how is this taxed? Now, let's go back here. I want to show you this slide again. Okay, let's say, for instance, because any of you can create liquidity pools on your own. Any of you can create liquidity pools on your own, okay? Now, one, you do need a little bit of time to get into these liquidity pools, okay? To figure out, to manage, to make sure that things are on the up and up, all right? Every single week, I would probably say 2 to 3 hours of just making sure, getting in there, touching some things up, okay? And we teach you that. Or we could manage it, right? Now, here's the thing. If this was you, like you set up this FXS pool and this ETH pool, well, these fees, once you claim them, this now becomes a taxable event. And Lorenzo is going to talk about this at length today. All right. This now becomes a taxable event. Now, if you invest in the managed vault, okay, the fees that we earn on your behalf do not get taxed until you withdraw your money from the managed vault. So there is a deferred tax on this. And if you were to pay taxes on this is short-term capital gains, which you're going to get taxed in the United States at ordinary income. Where here, if you stay in the managed vault for more than a year and 1 day, well, now you're in long-term capital gains. And again, you don't pay those long-term capital gains until you withdraw that money. So this money gets to get compounded tax-free. Let me bring Lorenzo on here. Lorenzo, are you there? Let's see here. Let me escape this. Can we bring Lorenzo on? Let me see here. I think you're on mute.
Yeah, I'm
there
on
we
mute.
go.
There we go.
How's it going, Lorenzo? How's it going?
Let me move this.
So
3 screens here. Let me move it in the middle. All right.
Awesome. So do me a favor, Lorenzo. Tell everybody you're the CPA. Now, Lorenzo's a CPA, and by the way, for those of you who got here late, Lorenzo is, in my opinion, the top crypto CPA in the US. Hands down. This guy knows his shit, all right? This guy knows his shit. So, Lorenzo, you and I talked about this. We've been talking about it now for weeks, and you've been in the ARC for over almost 2 years now. You know about the managed vault. So tell everybody a little bit about how this works in the traditional sense so that they can understand this a little bit better. You're on mute again. You're on mute.
There we go. You hear me?
There
good?
we go.
All right.
Yep.
Awesome. Yeah, and honestly, one of the other parts of this with investing in liquidity pools, I mean, this is such a cleaner way to invest in liquidity pools because it causes such a mess on the tax software side. I mean, there's so many transactions going in and out, and it adds such complexity to an individual's tax return that doing it in this format really saves a lot of headaches and trouble on the back end. And, yeah, just like as Gavin was saying, I spent a lot of time in the crypto space since 2016. I've just seen a lot of stuff, worked with a lot of different clients in so many different areas. And, one of the biggest challenges that we've seen is actually how to record and manage the books for an investor. And in many cases, through each of the bull runs, we've experienced new challenges. And in the most recent bull run, a lot of people got into liquidity pools, and they've gotten very exotic. They have different pairs, they've all different. You use a lot of coins that you traditionally weren't able to provide liquidity for. The meme coin run went on. A lot of these smaller altcoins were created, and you were able to leverage it using DeFi that once wasn't available. So the accounting software has had a hard time keeping up with all this innovation. And what ends up happening on the back end, anytime you add pairs to liquidity pools, you're having all these different transactions going. And it's very difficult for the accounting software to read what the actual effect is going to be. So now with what you've done with the vault, which is so interesting, is someone could put money in, let's say today, it goes in, you have a capital investment, all this stuff happens in the back end, and when the taxable event happens, you're skipping all those taxable events, and then when you go and you take your money out, the net positive effect is when you will record your first taxable event. So you're avoiding all these microtransactions that are causing events along the way and consolidating it down into really one transaction, or when you're liquidating. Just like if you were to sell stock, like if you bought Tesla stock and all this stuff happened in the back end, it's when you actually sold that stock is when a taxable event occurs. So it's a real innovative way to invest and do liquidity and have that exposure to liquidity pools without dealing with a lot of the headaches that come along with it.
Yeah, and when I actually thought about this, I was like, wait, like I haven't pulled out, because obviously I'm the founder of the vault, and I haven't taken anything out of the vault. And when I went to go look at my taxes that I did with you, and he's got a guy named Pete who's just a killer crypto tax guy as well. They go through all your stuff. It's super easy. And I saw that there was nothing for all these things, for all these other liquidity pools that I had gotten into. Yeah. But for the managed vault, there was nothing. And I was like, oh shit. Yeah. Like, wow, wait, hold on. I didn't get taxed on this. And I was just blown away. I was blown away. And I was like, this is the perfect way for people to participate. Now, I'm not saying you put all your crypto in here, because there are other opportunities that we're investing in, right? And there are other liquidity pools that, hey, I'm going to get taxed on it. All right. And there's creative ways, though, to minimize taxes there.
Yeah. I mean, this isn't the only way, but in my opinion, and looking at it from a tax perspective, if you can utilize this service and not have to pay taxes along the way, your goal is to reach that 1 year mark. Because once you create long-term gains and not short-term gains, you can significantly reduce your tax rate. So just to put it into perspective, long-term tax rates are either taxed at 0%, so you potentially may not pay anything in taxes, 15% or 20%. Short-term rates go as high as 37% plus your state rate. So you can talk over 40%. In certain states like California, you pay top tax rate even on long-term or on the state level. Sorry, on the state level, I apologize. So you're talking 37, 35, 32, 24, 22. In 22,000, a 22% tax rate comes really fast. I mean, anything above 44 grand in income, total income, you're now at that 22% rate. So it can be super beneficial to put a portion of your funds in look at it as a long-term play, let it sit there and accumulate and compound. And then once you're done, you can have like, keep it like make a calendar, maybe notification in a year. And then once that year hits, you could start liquidating and pay, assuming a lower rate. Obviously, we don't know what tax rate it's going to be at, but you're going to be at a lower rate than what if you would have sold under a year. So that's added ROI, in my opinion. Any tax savings, people don't like low key, like that's part of the calculation and what your ROI is. You've got to take in consideration the taxes that are due on it.
Yeah. Now, like one of the tax strategies that I used during the last bull market was borrowing against my crypto that I had made profits on.
Sure.
And it works very similar. For those of you who don't know, it works very similar to, let's say, for instance, you have a home that you own. And you have now equity in your home because the price of your home has gone up. Well, I'm now able to borrow against that home, right? And I can actually take profit and spend that money, and I don't pay taxes on that. Well, sure. I've been in crypto in a fully decentralized way. I'm not talking about, like, for those of you that have been around, like with BlockFi and Celsius, those were centralized exchanges still, where they had control of your money, and they ended up being a Ponzi scheme at the end of the day. A lot of them over-leveraged themselves. But in the blockchain, I never lost any of my money. It all was there the entire time. And because it was run and governed by smart contracts. Do you have a lot of people that, a lot of clients that use that strategy as well? Like borrow against their crypto?
Absolutely. And a lot of people got hurt in the last, that's the one thing, people don't consider is, okay, do I have enough money to, if I'm margin called, to save this thing? And if I can give any sort of advice on this, on how to protect yourself, that whole industry has gotten a little more advanced. And some of the protections that are there, if you do it in DeFi, you can be automatically liquidated. It's one of the downfalls of doing it in DeFi. But what you're starting to see now is people have learned from the mistakes and learned from the previous year's challenges. And what they're doing is making, just so people understand how loans work, if you got to take $1,000 out in a loan, and obviously the numbers fluctuate up or down, but it's all proportionate. They say, okay, you need to give me collateral. So we want, we're only going to give you 50% loan on your Bitcoin. So you have to put up $2,000 in Bitcoin to get $1,000 cash out. So they're going to hold $2,000 worth of Bitcoin to give you $1,000 bucks. It's like putting 20% down on your house for a mortgage, but they want more. They're over collateralizing it. And if Bitcoin drops to a certain point, they're going to ask you saying, hey, we're either going to take your $2,000 in because the price of Bitcoin has fell by half to $1,000 bucks. We're going to call that in, or you have to put up money to save your Bitcoin, or for us to not take your original collateral up front. So new players in the space, what they're doing is they're giving people more time to figure out and make that decision before they pull your initial capital out. They'll say you need to stay, it needs to stay under this threshold for 5 business days. And if it does, then you have another 3 business days to decide what you want to do. So it saves people from these flash crashes, and then people are getting liquidated on the spot because margins are called because of a flash crash. And you want to avoid any of these manipulations to taking your money for what? Because the market got manipulated. So protect yourself. If you're gonna loan off of your crypto, just be smart about it. Like, I think we even said people can book a call in here just to talk about these things. You guys do a really good job of educating people and being safe and doing this as safe as possible. So these are the things to consider if you're going to go and take loan off of your crypto.
Yeah, so everything that Lorenzo said is totally correct. But you can see here, this is one borrowing and lending protocol that I use. This is called FraxLend. Okay. Now, here's the thing. The cool thing is, and this is how I was talking to you guys about like being the bank, right? So what does the bank do? The bank usually takes your money and then they'll lend it out to other people, and they end up making this APR, right? But now we have the opportunity to put up our Ethereum, our Bitcoin, our staked Ethereum, and look what you're making per year in Bitcoin and in Ethereum. Now, this isn't as juicy as liquidity pools, but if you don't want to get as exotic as liquidity pools, you can just come here and you allow people to borrow against your crypto. And you actually, these are the rates that you would earn, because the protocol does take a cut, and they pay the holders of FXS in this the part of the dividends. But look at this. I mean, these are great rates. Look at FXS, 14.68%. This is one of the ones that I'm really bullish on, FXS, as I showed you in the liquidity pool. Sure. But this is, even if you didn't want to borrow against it, you could still put it in here and make some additional yield in a safe manner, in my opinion, way safer than these centralized entities that ended up collapsing during the last bull market.
Frax is an interesting platform, super interesting platform.
Yeah,
you guys are, ARK is big with Frax. You guys like Frax because it's honestly, it's one of the big players in this space that do this well.
Yeah, they just have so many different things going on. I mean, we can't call them a bank because, they're not like a licensed bank, but this is damn near a bank. I mean, they have access to stable coins, to liquid ETH derivatives. They have access to staking. They have access to what are called flat coins. That's a real interesting narrative. We're not going to talk about it tonight, but essentially flat coins keep up with inflation. So like if you're like, oh man, I need to have dollars because I need to just store my profits somewhere. Well, now with flat coins, you don't have to put it into dollars because dollars just keeps declining in value over time. Flat coins keep up with inflation. So it actually keeps up with CPI, Consumer Price Index. And they have a flat coin called FPI. You can see it right here. FPI, that's keeping up with inflation. So if inflation's 7%, well, that coin goes up by 7%, which is really, really cool.
Yeah.
Sorry, man. Go ahead, Lorenzo.
No, it's an interesting platform. I feel like it's updated all the time. I remember coming on here and seeing the lending protocols and stuff, but they've updated a few things.
Yeah. So Lorenzo, give us, in your opinion, a strategy that we haven't talked about here tonight that people can take away from this and really use this in their crypto. And by the way, guys and gals, you can book a call. There's that link here. You can take that link and copy it into your browser and book a call. And we're going to be giving away a free course that Lorenzo and his staff have pre-recorded on like the guide to doing your crypto taxes properly. All right. If you end up becoming a student of the ARK. All right. But tell us, Lorenzo, what's like a strategy that people can take away and they're just like, hey, I actually could make, save a lot of money in my taxes by doing X.
Sure. Well, right now, tax loss harvesting is the topic of the conversation. This is the end of the year. This is the time to do it. After 12/31, you can't do it anymore. So there's a deadline on it. So it creates a little sense of urgency for people to actually take action and really get an understanding of where their crypto books are. And the only way to do that is to use a software. I do not recommend anyone doing it manually. If you have a journal and you've kept good track of your trades, God bless you. Like, that's great. honestly, it's only going to make your life easier when you put it into a software. But I recommend every single person here before the end of the year to attach their wallets into a software. Like I said, anyone who joins, like I said, I've offered to give up my course for free. It's generally a $500 course. It goes through our whole entire process. So if you're a DIY person and want to learn how we handle our clients' crypto books and reconciliations on an annual or monthly or quarterly basis, all that's on the course. It's jam-packed with tips, pro tips, what we do on our back end. It's just like, we let it all out there for everyone to see, because some people want to be able to do it on their own. Honestly, your crypto situation best. Just because I've been in the space for so long, I don't know what trades you did that made or lost money. If you lost money. If you won big.
Real quick, Lorenzo, though, because there's probably a lot of people on here who don't know what tax loss harvesting is. Can you explain that a little bit more at length?
Well, again, it goes back to the fundamentals. Is the only way to know this is to know your numbers. And you start off by using a software, connecting all your accounts, wallets, exchanges to it. And what ends up happening is throughout the year, you've purchased assets and you buy it at a certain price. So let's say you bought Bitcoin, last week, or let's say, you bought Bitcoin at the last peak at, 60 grand. You bought it at, and you've held on to it all this time. And now you're like, what? It's 40 something thousand. I want to get out. I want to pull some money out. I'm going to sell. Now, throughout that time, you were in the negative. You bought it at a high point. You bought it at 60K, but you never sold anything. You just held on to it. So all this time, you have, they call it unrealized losses. Realized losses is when you physically actually trade. You create a taxable event. So until you sell, they call it unrealized losses. So you're sitting on these losses. Now, tax loss harvesting is when you finally make that decision. You see, okay, I'm in the red in this position. I know I have gains in either other assets, whether that's stocks, crypto, a passive real estate. Maybe you sold some real estate and you have these gains. You then go and harvest your losses to offset the gains that are on the other side. And this is the perfect time to do that. And this is where we're really busy right now as a firm, is speaking with our clients, seeing how the year went, seeing where they made money, where they lost money, and seeing what we could do about it. Now, if you have good clarity of where your numbers are and you're sitting on some losses, this is the time to take advantage of it to potentially save on your overall tax picture.
Yeah, so real quick, and by the way, we're actually live on YouTube. If you guys head over to gavensarial.arc, do me a favor, if you like this content, hit that subscribe button and the like button, because we want this algorithm to be shown to other people, because I think that this is something important. So when you're talking about tax loss harvesting, I think this is interesting because you can't necessarily do this with stocks, right? But with crypto, let's say, for instance, I'm holding some Bitcoin, that same example.
Sure.
I bought at $69,000 at the height of the last bull market. Okay. And as of today, I don't know, I think Bitcoin's like 43, right? Yeah. So I'm down, $26,000 or something like that per Bitcoin.
Yeah.
Well, I can now, but I'm like, man, my Bitcoin's up 100% this year alone, though, right? Like I wrote it all the way down, but now I'm riding it back up, and I don't want to get rid of this. Is it or is it not true that I can sell my Bitcoin and then literally turn around and buy it back?
So that answer is yes. And this is super unique to crypto. Like as you mentioned, this is not available in equities. You can't do this with stocks. They have something called a wash sale in stocks, meaning that if you sell your Apple stock and then you add a loss and buy it back within 30 days, they negate that loss. So super, super unique at where you can actually take those losses, sell your Bitcoin, realize the loss. Like in that same example, you take that $26,000 loss if you had one Bitcoin, and be like, I don't want to get rid of my Bitcoin, so I buy it right back. What you did at that point is you realized $26,000 loss, but your basis, your initial buy-in for that Bitcoin went from 69K down to 43K. So 43K now is your new start point, and you will have gains or losses starting at the 43K now versus the 69 what you previously were at.
Nice.
Really,
I've
really
actually
good
done that.
strategy. Really, really
Yeah,
good strategy to use, and it costs you basically nothing, which is the best part about it. Is it's the best tax planning you could do because it doesn't cost you anything.
Yeah, 100%. So for those of you that are in the audience, does anybody have any questions? You can type it in the comments, and we'll pick up some questions. I see that there's just some people trying to register for the site. Again, take that link and then cut, copy, and paste it. You can get it over there. But any questions in regards to taxes? Let's see here. I don't see too many active people in here. All right. No questions. No questions. All right. Well, guys, gals, again, head over, book a call. We're interested to see if we're a good link. And we're going to include Lorenzo's course for free if you end up becoming a student of the ARC. And we're interested in talking, like, at the end of the year right now, this is the time that you can make up for a lot of tax ground if you're smart about it. So let's see, where can I get a consultation for taxes? Is there a website that you have, Lorenzo, that we can send?
If you go to lorenzotax.com, you can then just put in your information. Says there's a link there to book a call. And we have a free 15-minute call with someone from the team. More than happy to answer any questions that you have, get you any information that you need. Like I said, what we're doing here with ARC today is I have that course, which is if you're more of a DIY person, you can go that route. That's included with ARC, all about the education, with the programs. But if you have a more specific question, or you're interested in becoming a client and you need help with more hands-on work, then for sure, go to lorenzotax.com. Just click book a call there. Let me know that you came from ARC and stuff, and we're more than happy to have a conversation with you to see how we can help you.
Awesome. I just dropped it in the chat, lorenzotax.com. So you guys can go there.
And honestly, like, is this at the end of the year here, is if someone's had significant gains, this is the time to really do something about it. And there's so many ways you could chop this up. It just really depends on your fact pattern, where you're at in life, what you're trying to do with the money, your timeline, how much you have already in your estate. There's so many questions to go about. We really take a more bespoke approach into tax planning if necessary and needed. There's very simple solutions, which any CPA should be able to do. Like the simple stuff are your musts. If you check all those boxes and you did you call it like the textbook tax moves, you did all the TikTok tax advice that's out there, then you start going into the more advanced tax planning side, and that's something that we do generally with our more high net worth clients. So it's wherever level you're at, there's something that you could do, and if you feel free to book a call, we're more than happy to lead in the right direction.
Lorenzo, somebody here said, can we deduct any of our coaching fees? So if they come over, do the ARC, can they deduct those coaching fees?
It's a great question. And the answer is most likely yes. It depends on what type of what your personal situation is. If you just have a W-2 job, then you'd have to create something in order to take that deduction. If you're on a 1099 or you're in your own business, it absolutely can be a deductible expense. What I would suggest if you are on a W-2 job is maybe this is time to start your own little side hustle. And this is part of tax planning is okay, if I'm limited in what I could do because of my career and I'm happy at my job, I don't want to leave and start a business. But that doesn't mean that you can't do it from a tax standpoint. So you can start a little LLC. You don't even need to get that formalized. It could be a sole proprietor. Maybe you go and you open up a bank account, you open a business credit card, and Just because you're in business doesn't mean you got to make $1 million in business. You can, use this as your business. There's ways to do that. And so to make a simple answer, yes, you can be deducted. To make it a little more complicated, it really depends on your fact pattern.
Got it. Another question here is, what is the recommended tax software?
Sure, love it. Yeah, so for me, as a retail software, there's a handful that we use, but as a retail software, I love Coinly with a K. We actually have a wholesale license with it. I mean, we work with ARC on providing that for the clients that do even enroll in our courses and whatnot. So we have the $500 executive plan, which we include in a lot of the jobs, and really all our jobs that we do. Our clients never pay for the tax software. But if you have minimal transactions, I mean, it can be affordable, but it scales up with how much volume that you have in terms of cost. I find that to be the best for DeFi. It connects with all the wallets and exchanges. They've done a really good job over the years of updating it and making that when you connect all your accounts, it does a really good job of reading it. So less manual work that you need to do. But pretty much 9 times out of 10, once you connect it to the software, there is a little bit of manual work that needs to get done. And that's where we come in hand, or the course comes in hand, or ARC comes in hand in helping people navigate that, because it can get a little confusing. But Coinly is what I love for retail. If you're a high frequency trader and you have more than 30,000 transactions, we use a few different softwares depending on what you do. If you're a company and you need balance sheets, or you have to have it connected to QuickBooks, we use a couple of different corporate softwares like Cryptio or Integral. So there's never a one size fits all for the softwares, but generally speaking, for a typical investor, Coinly is the best solution that I've come by.
Nice. Yeah, I've used Coinly now for 2 years since I've been with Lorenzo, and boy, did it make my life super easy. Super easy. So I want to clarify something, because I keep seeing here, Charity asked, I'm already a student of the ARC. Do I have access to Lorenzo's courses? So if you are ARC Apex or higher, I forgot to mention that, not ARC WealthX, which is our lowest entry level to get in, you will have access to that. You will have access to that. So we're excited to bring that to all of you. But if you're AWX, ARC WealthX, maybe this is your incentive to now upgrade, because there's lots of value that you're going to get out of this. Lots and lots of value you're going to get out of this. So let's see, any other questions here? If I link my ledger in Coinly, do I need to link any other wallets? Yeah, Ja, you need to link any active wallet that you have.
Yeah,
okay.
I mean, everything, honestly, so everything's gotten so just transparent at this point. If you have activity in it, just link it in. That's just my motto, is if you're thorough with it, you're just making your life easier. If you had big gains, then there's ways to deal with the taxes in a defensible way than just to not report anything. So I would just put everything on there. Then you'll have an idea of where you're at, and then how to best manage that, where your position's in. So that's always been our motto. We're really strategic in where we're aggressive, and what I would suggest is that will also give you the best results in Coinly, the most accurate results, because when you're not adding everything in, you're sending money places, you're getting money from somewhere, it's misaligning transactions, your cost bases are off. Just put all your stuff in there that you've used, even if it's not active, because even previous cost bases are maybe important that you draw from a non-active wallet.
So Ali says, how secure is the private data share will be? How secure the private data, my data share will be? I mean, I'm assuming it's pretty darn secure with Coinly.
Yeah, I mean, it's just read-only data. So if you're API connecting something, like, you're not giving it access to do anything on your behalf, or or it's just view-only access. You're either going to ingest a
it reads it right off the blockchain, right?
Yeah, and if you don't want to API anything, you could just download CSVs and upload CSVs. I mean, that's also a possibility. So if you're worried about API connections with anything, then just download the CSV, and that's how you can give it the data. Just be careful doubling up on CSVs. If you put something in, you don't want to. You got to be careful of your dates. So like, and download all your CSVs, because sometimes there's CSVs for just deposits and withdrawals, and there's one for just spot trading. There's one for derivative trading. So just be thorough in getting all the data in, and then be really conscious of your stop and start dates if you're going to put multiple CSVs in. That's my little pro tip.
So one last thing before we log off here. So Lorenzo, I know you've done like a lot of work with people who already have like another CPA, like they just like have their family CPA that they're just comfortable with for so many years, and you just do like the crypto side, right?
Yeah.
You've got a lot of clients that you've done. I just referred to a client the other day like that, where she had her own CPA and you just did the crypto side. I just wanted to let everybody know, like, even if you do have a CPA that you trust and you know, like, chances are they don't know shit about crypto. All right, not even 1%. And Lorenzo can still work with you guys, and it's not going to cost you an arm and a leg. It's really reasonably priced. So I just wanted to throw that out there, because I know that it's probably sometimes people just think like, no, it's my friend, like.
And then the beauty of what also we do, that's a good point, Gavin, because like a lot of people do have someone that they trust, and if it's not broken, don't fix it. And what we do, just to make everyone feel comfortable in the situation, in the transaction, is I sign off on everything related to crypto. If you're ever audited, I sign off on every document that goes out. So if you're ever audited, we're here to assist you. We've been through audits at this point. I have a chain analysis license, which is, it's up to $50,000 a year now. That's the software. That's the investigative software the IRS uses if they ever want to really look into something. Like I said, we've dealt with audits at this point. I'm not afraid of it. We do a really good job. We put our name behind all the numbers that we put out. So other CPAs like that, because they don't like taking on that work and maybe that liability. We'll assume that part of it, especially if we're working with another professional. So generally, I'll take those calls if we're working with another CPA to make sure that they're on the same page. So it's I know it's a sensitive issue for many, but we try to navigate that as best as possible.
Awesome. All right, guys and gals, again, if you are interested in learning about how you can participate in DeFi, click on that link, put it into your browser, book a call. Let's see if we're aligned. If you're interested in learning about Lorenzo's stuff through us, again, book a call. Let's get you in. And we do a live every single Thursday. So if we haven't earned your trust yet to come into the community, keep showing up to the lives. We're going to keep dropping free knowledge, and we're gonna keep it rolling. And right now, guys, gals, the market is heating up. Do not stop learning DeFi, because it is taking off right now. And at minimum, if you're not going to become a part of a community like ours, at minimum, keep educating yourself, because I promise you will not regret it. You'll be like, hey, who's that guy that told me about DeFi back in 2023, the end of 2023? And hopefully I'll get a little credit there. So, all right. Take care, guys. Sending you lots of love.
Take care, everyone.
Thanks, Lorenzo.
Cheers.